I work with business leaders who want assurance, not just numbers. Today, we're talking about how professional review and audit services drive confidence that directly influences financing costs, lending terms, and trust. This is not a technical accounting discussion. It's a strategic conversation about how credible financial reporting shapes how banks, investors, and counterparties evaluate your business. For those who don't know me, my name is Nizam Shajani. I'm a chartered professional accountant, a trust and estate practitioner, and a tax and assurance partner working primarily with family owned and owner managed enterprises right across Canada. My work sits at the intersection of tax strategy, financial reporting, and business decision making. I don't just prepare financial statements, I help business owners understand how those statements are used by lenders, investors, and strategic partners. Over the years, I've seen a consistent pattern. Businesses that treat financial reporting as a compliance exercise get average outcomes, and businesses that treat it as a trust building tool get better access to capital, better pricing, and better strategic options. At their core, financial statements serve one primary purpose: they establish trust. Internally, they help owners and management make informed decisions, and externally, they help third parties such as banks, investors, and bonding companies decide whether they can rely on you. And here's the critical point sophisticated business owners understand. Lenders don't just lend based on optimism, relationships, or explanations. They lend based on confidence in information. That confidence doesn't come from management alone, it comes from independent assurance. This is where review engagements and audit engagements come into play. A review engagement provides independent professional comfort through inquiry and analytical procedures, and it tells the lender these numbers are plausible, consistent, and professionally vetted. An audit engagement, on the other hand, goes deeper. It provides the highest level of assurance through testing, verification, and evaluation, such as internal controls. And it tells the lender or investor these numbers can be relied upon for significant decisions. Neither of these services exists merely to satisfy a requirement. They exist to reduce risk, lower uncertainty, and ultimately improve the cost and availability of capital. That's the accounting and assurance side of the equation. The more important question, and the one business owners actually care about, is this: how do banks interpret these financial statements when real money is on the line? To explain that, I'm joined with Mirza, who will bring the lender's perspective on what actually matters when financial statements land on a creditor's desk. If you're growing, refinancing, or planning for an exit, the quality of your financial reporting will quietly but decisively shape your outcomes. When most business owners hear the term review engagement, they think instinctively as something sitting between compilation and audit, almost like a compromise. That framing is technically correct, but strategically incomplete. A review engagement is not a watered down audit. It's not an upgraded compilation either. It's its own assurance product, designed for businesses that want credible, independent validation of their financial reporting without incurring the full scope of an audit. At a high level, a review engagement provides limited assurance on financial statements. That assurance comes primarily from two things. First, inquiry, asking targeted questions of management. And second, analytical procedures, examining relationships, trends, and variances in the numbers. It goes well beyond simply assembling information, which is what a compilation does. But it stops short of transaction level testing and control testing, which is what an audit requires. In practical terms, it answers a very important question for third parties. Do these numbers make sense? Are they consistent, and do they align with the underlying business reality? This level of assurance matters more than most business owners realize. For lenders, investors, and sophisticated counterparties, a review engagement signals that financial statements were prepared professionally, they were independently assessed for plausibility and consistency, and material issues or unexplained variances were challenged. That alone elevates the credibility of the information, especially compared to internally prepared or purely compiled financial statements. At the same time, a review engagement remains cost effective. You're getting professional scrutiny and insight without time disruption and costs associated with a full audit. Another important and often overlooked aspect of review engagements is the quality of insights they generate. Because analytical procedures are central to the engagement, we spend time looking at year-over-year trends, margin movement, changes in working capital, shifts in debt structure, relationships between revenue, expenses, and cash flow. For business owners, this improves transparency. And for lenders, it demonstrates that the numbers have been professionally interrogated, not just reported. This is why I often say that review engagements are not about compliance, especially for sophisticated businesses. They are about strategic validation of financial health. They tell the market, we understand our numbers, we take financial reporting seriously, and we're prepared to have those numbers scrutinized. For many growing or mid-market businesses, a review engagement is the right balance. Gives you more credibility than a compilation, meaningful assurance for lenders, and a proportionate cost relative to the size and complexity of the business. From a cost-benefit perspective, this is where review engagements shine. They deliver significantly more comfort than a compilation without the full procedural, scope, time commitment, and cost of an audit. In other words, you're not paying for assurance you don't yet need, but you're investing in credibility you absolutely do need. For many business owners, especially those in financing discussions, that incremental investment pays for itself through smoother lending conversations, fewer follow-up questions, and better internal clarity. A review engagement gives lenders and investors comfort that the numbers are consistent, credible, and professionally assessed. The real question, though, is how that comfort actually shows up in lending decisions. To explore that, let's hear from the banking side of how review financial statements influence real-world financial credit decisions. At this point, I want to bring the banking perspective into the conversation. I'm joined today by Mirza Amiri. Mirza has spent years working directly with business owners, management teams, and credit committees, evaluating financial information and making real lending decisions. What I appreciate about Mirza is that he sits at the intersection of the relationship banking and risk management. He works closely with clients, but he also understands how decisions are made internally, what gets scrutinized, what builds confidence, and what creates hesitation. So today's goal isn't theory. It's to understand how financial statements are actually used when capital is being allocated. Mirza, I've walked through review engagements from the assurance side. How do they provide independent comfort and elevate the credibility of financial reporting without being a full audit? I'd kind of like to shift now to your seat at the table and talk about what really matters when a set of financial statements lands on your desk.
Normally, when we receive financial statements, depending on how they are presented, review engagement or some other type of financial statements, we look at a few signals, a few things that would give us the preliminary trust on what are some of the things we could do with these financial statements. Number one thing that we look at the financial statement is internal consistency, how the financial statements are prepared. Do they tell the story? How do we understand the trends? How does the quality of the work look like? And then around the adjustments, what kind of transparencies are there for us to understand and kind of influence our trust. And when it comes to revenues, recognition of revenue in different situations, how those are calculated, what kind of notes are there, meaning that when we look at the financial statements, do we see the story being told through numbers? And the more consistent the story, the more, trustworthy those financial statements would be.
Okay. So what about on the contra side? Are there areas that make you think maybe these financial statements are not as valuable or not necessarily reflecting the full story of your client? Think about maybe something that stands out that creates a little bit of uncertainty.
Coming back to that consistency, if we find inconsistencies and we find like numbers are not matching, or the story that I just kind of referred to, if that story is broken, then it creates, questions to our mind, and that questions would have to be answered. We have to go back and forth. We have to kind of understand why this was done, and the more inconsistencies, the more broken parts to the story, it would delay the work. It would create more kind of friction, as well as affect our trust. So those are the things that we look at a financial statement.
So the confidence isn't just about the strong numbers, but it's also about being able to explain inconsistencies and making sure there's a coherent story behind the numbers as well.
Absolutely.
So let's talk specifically about assurance level. From a risk perspective, how much more confidence does a review engagement give you compared to a compilation or something that's just prepared by the client themselves?
In our part of the world, in the past, we used to sometimes rely even on notice to reader financial statements for smaller things, and then from notice to readers, then to review engagement, then to to compilation engagement, then to review engagement, then to audit. So the higher we go, the assurance improves. With the audited financial statements, we have the highest assurance that the numbers have been looked at by professionals. They have done their things. They have done their reviews, and consistency. Different eyes have looked at these numbers, so we have more assurance on our side looking at those numbers, and with the notes and everything, we understand the numbers a bit better. When we come down to review engagement, the assurance we get from those review engagement is limited. It's not full assurance as we get from the audited financial statements. Review engagements are still better than compilation engagement, because in review engagement still there are notes, there are things that we could go through and understand the financials better, understand the stories better, the presentation better, but it's not full assurance, it's limited assurance. And then when we come down to compilation, not much of assurance. NTR, we're not even looking at them anymore.
Yeah. So does it reduce the number of follow-up questions you end up having if you get something with, let's say, a review engagement or an audit? Does it decrease the amount of follow-up or additional checks that you have to do yourselves?
Absolutely. Because, the more assurance we have, the more consistency in the numbers, We do not have to go back to client or to the client's accountant to ask for more details. Normally, if we can't find anything in the body of financials, we could go down into the notes and find details in there. So it does save a lot of time and back and forth.
Okay, so it doesn't necessarily eliminate risk, but it reduces your information uncertainty because there's other areas within the notes of those reviews or audited financial statements that you can get your answers from as well.
Exactly. Yes. It doesn't. Risk is always there, but the assurance level is higher, and as long as we find the information ourselves around the financial statements, without going back and forth and doing meetings and stuff like that, it's easier. It's time saver, and the higher the quality of the financial, the better the assurance and the better the outcome.
Banks often talk about ratios, and I know in practice that there's really just one metric that we end up looking at. But what ratio or trends matter most to banks when they're trying to go through somebody's financial statements? What really sticks out? What are the things that you guys look for?
We look at each deal differently. Different deals have different requirements and different ratios, depending on what kind of deal we are looking at. If we're looking at a cash flow loan, for example, a share ownership loan or something like that, then ratios are different. If we're looking for a commercial mortgage, the ratios are different. But almost always we start with debt servicing ratio. So that's the number one, the debt service coverage ratio. That's always number one. If the client has a cash flow positive and they are able to, debt service the loan that we are giving them, they are able to, make the payments on time comfortably. That's number one. And then depending on different situations, different types of loans or asks or requirements, or even the volume of the debt they're asking for, we look at second kind of very frequent is leverage ratio, which is total debt over EBITDA, and that's also important to understand how leveraged the clients are and how much more they are asking for. And then we also look at liquidity ratios. We need to understand how the working capital is, how much they have, how the trend has been in the past, and so on, current ratio, cash trends and stuff like that. And then, of course, profitability ratios are very, very important. Net margins, return on assets, return on equity, all of those things are that, stuff that we look at the normal course of our analysis.
So you really get the numbers to tell you a story. Are they able to fulfill their obligations if you were to lend them a certain amount of money? Do they already have a lot of debt already? And you're trying to figure out, just basically using the numbers to give you a story about the client.
Absolutely, yes. It is stories told by numbers.
Yes. What about, you mentioned accounting profit as well, and you also mentioned cash flow. So how do you kind of look at that? A lot of people look at just their profitability, their accounting profitability. What about cash flow? How do you take that into account? Keeping in mind, I know compilation engagements usually don't have a statement of cash flows, whereas review engagements, audits usually do. What impact does cash flow have in your decision making?
It has a lot of impact depending on what kind of deal we're looking at. If we're looking on a cash flow loan, for example, statement of cash flow is very, very important. We have to look at the cash flow, how much cash came in, how much went out, where did it go, and how much came in, where did it come from, and at the end of the day, what kind of liquidity ratios do we have to see if the story makes sense. Yes. And cash is king.
Yes. I find banks often ask for not just 1 year, but 2 or 3 years of financial statements sometimes as well, and sometimes more. Do you guys end up looking at trends? So when you're looking at the ratios or looking at the cash flow, are you also looking at the trends where they may be working in a positive direction or not so positive direction?
Always, we have to look at trends, because one year financial statements would not tell us a story. We're always looking for trends, be it expenses, be it profits, be it cash flow, whatever they are. We look at trends. We normally, and not only us, all the banks normally look at least 3 years of financial statements, and the more the better.
Yes. So I guess the distinction between getting like an assurance type engagement through the audits or reviews, you're relying on a story. You're going on a story, and when there's more assurance, I guess that story is more reliable, more believable, and especially if it's a trend over time. Then,
Yeah,
right?
yeah.
Okay. Internally, at the bank, do you differentiate between reviewed and audit financial statements? And if you do, when do you decide a client you're satisfied with a compilation engagement, or if you need to move more to a reviewed engagement or even toward an audit? What's the decision making criteria at that level?
Um, it depends on different situations. Sometimes we start with clients who want to start small. Normally, people start small and then they grow and they ask for more. And that way we want to be their partners in their growth. And as they have moved from certain stages to another higher stage, then we realize that now we need better quality, higher quality financial statements, normally based on different types of deals. There are policies around numbers. If you have X and X number or more, then you got to provide this kind of financial statements. If it is less than that, you got to provide this kind. As I said earlier, in the past we used to look at NTRs.
Yes.
We are not looking at them anymore. No more NTRs. Not even I don't know if the small business portion of banks look at NTRs, but at the commercial level, no more NTRs. We start from compilation engagement and go up, and as long as you're up to certain level, we can do with compilation. But as soon as the limits go up, then we have to ask for higher quality. And there are certain industries that no matter what kind of limits they are asking for, we ask for audited financial statements. For example, condominium corporations, no matter if they are asking for a $500,000 loan or a $5 million loan, we ask for an audited. But then different industries, different situations, we decide on what kind of financials they need to provide. If they are new companies and kind of they provide some information to us, let's say they have compilation and they are asking something, then when we issue the term sheet, during the term sheet, we realize the type of deals and the type of structure that we are making for them or proposing to them. Then we tell them, hey, our requirement going forward would be, if we're going to sign this agreement, our requirement would be that you should provide this kind of quality of financial statement.
And kind of looking at perhaps the bank's risk level comes down when they have an assurance type financial reporting. Does that impact pricing at all?
It does,
Yeah.
but indirectly. The risk normally comes from the borrower risk rating.
Yeah.
Borrower risk rating comes from financial statements. And the better the financial statements, then they would produce better borrower risk rating. Yeah. And then if we have better borrower risk rating, then the risk-based pricing would be affected.
Interesting. So, and does it make it easier? Because you're in an interesting position where you're sometimes advocating for your client, but also protecting the bank from risk as well. Does it make it easier for you to advocate for your client internally when there are assurance engagements?
Absolutely, because you know, the better quality of financial statement tells a better story about those who are running the companies.
Yes.
They are making themselves available to scrutiny. They are using experts from outside to get their financial statements, to the higher quality and all those things. So it makes life easier for us as well.
Wonderful. It's interesting to hear from the lender's perspective, because always being on the accounting side, sometimes trying to figure out what you're interpreting from the numbers and information that you receive as well. So, kind of what I'm hearing overall is even the type of financial statements that you receive, whether it's compilation or review or an audit, in terms of what you even mandate for certain loans, is industry specific. It's the amount of loan that's coming in, and maybe just kind of that overall feeling in terms of the risk that you perceive from the client, and really trying to give you a leg up so that you can advocate on behalf of your client in a positive way if you get a stronger set of financials that they can, or a stronger level of assurance.
Yeah. Now the thing, a lot of our work is based on trust as well, right? Again, when it comes to quality of financial statements, it builds better trust, right? If it is, if it is me who trusts my client and what my client tells me through their numbers or through whatever, then I have the trust built here. I can do my part to get whatever I can for my client, to provide my side of trust to them.
What we've just heard from Mirza reinforces an important point. When the size of the decision increases, the quality of assurance matters more. That's where audit engagements enter the conversation, not as a regulatory obligation, but as a strategic trust mechanism. So I want to spend the next few minutes unpacking what an audit actually provides and why sophisticated businesses choose audits well before they're forced to. An audit engagement delivers the highest level of assurance available under Canadian standards. Audits are conducted in accordance with Canadian generally accepted auditing standards, which is why lenders, investors, and institutions place such reliance on audited financial statements. Importantly, audits don't rely solely on inquiry or high-level analytics. They go further, testing the transactions, verifying balances, and examining documentation, and assessing whether the financial statements fairly reflect the underlying economic reality of the business. That level of rigor is precisely why audits carry so much weight in significant accounting and financial decisions. When a business is seeking material financing, preparing for a sale or a merger, or engaging with institutional investors, the risk tolerance drops dramatically. At that level, stakeholders aren't asking, do the numbers look reasonable? They're asking, can we rely on these numbers to commit real capital? Audited financial statements answer that question in a way no other engagement can. They reduce information risk, and in capital markets, reducing risk almost always improves outcomes. I want to address a common misconception. Audits are often viewed as a mandatory burden, something you do because a lender or regulatory institution requires it. In practice, most sophisticated businesses view audits very differently. They see audits as a strategic differentiator. Strong internal controls, documented processes, and independently verified numbers. It reduces risk, it increases lender confidence, and can directly influence the cost of capital. In many cases, the audit doesn't just support financing, It improves the conversation around terms, structure, and timing. Another underappreciated benefit of an audit engagement is the insights they provide. Because audits involve deeper examination of systems and processes, they often surface control weaknesses, inefficiencies, or risks that management may not see day to day. Addressing these issues early strengthens the business, not just the financial statements. That's particularly important where business planning, growth, and succession or exit come into play. This is why we position audit engagements as tools for credibility, transparency, and growth. They support better decision making internally, stronger confidence externally, and smoother execution when capital or strategic transactions are involved. In other words, audits don't just slow sophisticated businesses down, they prepare them to move faster when opportunities arise. So, whether we're talking about review engagements or audits, the theme is consistent. Assurance is about trust. Next, we want to bring this together and talk about how the level of assurance, review versus audit translates into real differences in lending outcomes, speed, and confidence. We've talked about assurance conceptually, and we've talked about how financial statements are assessed. I want to bring this down to the practical level. How assurance actually changes the outcomes when a credit decision is being made. So let's start with the mechanics. From the bank's perspective, how do reviewed versus audited financial statements influence loan sizing and covenant structure?
Normally, for the larger loans, and depending on the industries, the audit financial statements would be required. And review statements are for the smaller loans, and also totally depending on what industry they are. So, as I said earlier, sometimes we, in our term sheet, kind of advise our clients or the brokers or whoever we are dealing with that if we want to do this together, we will require this kind of financial statements, and it's again the deal size, the industry, and the trust that we have with the borrower that will dictate what type of financial statements would be required, and then the covenants as well. With the better quality of financial statements, normally we don't have to do multiple reviews of the covenants or testing of the covenants during the year. If we have lower quality of financials, then we may decide to do multiple, for example, quarterly covenant testing or semi-annual covenant testing. But if we, from the get-go, we have better quality of financial statements, and we know that different set of eyes are have looked at these numbers in the past, and they have given us a written document of what they think about things, then we may decide to not go for quarterly or semi-annual covenant testing. We might rely only on annual testing, but annual testing is mandatory, and it is there all the time.
Okay. So it really reduces kind of the process, the oversight, I guess. Once you get kind of a good set of financials, it's not as regular, and a little bit more trust in the numbers, I guess.
Mm-hmm.
You mentioned a term sheet, so maybe take me kind of through the process of getting a loan with a bank. So you provide the loan, you go to the lender, say I need $1 million. You'll obviously ask for certain documentation such as the financial statements. Then it goes into the term sheet process. What does that look like? What is a term sheet, and what's included in there?
So this is a different process for different banks. and sometimes term sheets are, a concept, a structure that the bank could provide to their prospective client, saying that based on what your needs are, we could offer these and this and this to you. These would be our requirements. This would be our covenants. This would be our fees. This would be, your responsibilities and whatnot. So the process basically begins, as you mentioned earlier. A set of financials come to our desk with a ask. We go back and forth if we need to get more details, understand situation, understand the needs. Then we decide on how do we best structure this, how it makes sense for us and for the client to do this, and what is the best way, easiest way, or cheapest way sometimes. And then we prepare a term sheet. The term sheet basically tells the prospect that we're offering you this loan and that loan, and based on this and that loan, these are our requirements, these are our covenants, these are our reporting requirements, and this is how much time it would take us to get this to the close. And then we meet with our prospects, and they ask their questions. If they don't understand, then basically that's an offer that here is what we could do for you. And if it meets their need, and if they're happy with what we have offered to them, then they sign the term sheet. And once they sign the term sheet, then the real work begins, putting the term sheet into our system and basically making the ask happen.
Okay. So then I would assume that term sheet also includes things like pricing, interest rates, other fees that are included as well.
Absolutely, yeah.
So what helps impact what that pricing is, what the and what the interest rates are? I know there's market fluctuations out there as well, and of course you guys have your own investors and shareholders that you have to make happy at the banks. But that aside, what are some of the things that someone can do to try and impact that interest rate to be lower, the pricing to be lower?
Again, there are so many question marks around pricing. The pricing comes from number one, risk on the borrower, and then borrower's industry, and then the management, how the management is, and how we could get the story from the numbers that we have in front of us, how successful the company has been, how trends have been in the past, what they have done, the quality of the financials. All of those make sense. Again, to come back to accounting, how accounting would help borrowers get better rates is through the quality of financials. The less we go back and forth, and the better the financials are presented, they would create better borrower risk rating, which is about this customer. And then we have better borrower risk rating, the better the rate would be. Then next thing would be about what industry they are in, and how long they have worked, and what kind of other stuff they have. What kind of trust we could build, we could put on the management of the company, stuff like that.
Yeah. And in terms of speed of approval, I always get clients who need things done right away. I'm sure you do as well. What can impact the speed of an approval at the banks?
Speed is always something that everybody is struggling. It's the more we go back and forth, the more time we spend.
Yes.
Right? And then if we have to go back and forth, this back and forth, we might lose something here and there and so on. and then our deals would have to go through adjudication. If the financials do not provide the whole story, then the adjudicators would not understand the financials well, and then they would have to do a lot of back and forth with us, and that wastes time too. And then if the deal has to go to risk, the same story happens in there. If we have a full story, and in the very beginning, a short set of financial statements that tells us the full story, and we have the notes, we have all the details, then we don't have to go back and forth, quickly understand things, get our answers from the document, write up our things, send it to adjudicators, they do the same thing, send to risk, they do the same thing. It saves us all three levels a lot of time. But if we have to go back and forth, then that is the number one issue of delaying things. And again, sometimes some people we deal with, they are very responsive. Some other times they are very busy. It takes them time to get us the information. Sometimes we have to go to clients' accountants through our clients. So we give the question to client would give it to the accountant, and then the information comes back through the same channel. If we go directly to the accountant, then it's easier. We could ask more questions back and forth and so on. So I think if we have a full package, all the information as much as possible in the first place, that saves a lot of time.
Yeah, I've found that it's also easier if the accountant has done an assurance engagement. They already have that documentation. They had to gather that during that process. So often it's easy, as I'm sure it sounds like you've noticed, to just go straight to the accountant and ask them for these documents that the client may not know where it is, but the accountant's already gathered it as well.
Or sometimes the client may not even understand what you're talking about.
Yes.
Because, managers, owners, CEOs, they know their business. They know how to run that business or the product, but they might not know the accounting part of it or the jargons or stuff like that. So it's easier to deal with professionals who understand what language you're talking about.
Yeah, that's it's a critical point, I guess. The assurance isn't just about the decision making. It also helps with the efficiency of how decisions get made as well.
Exactly. Yeah.
Right.
Yeah.
Maybe without getting to specifics, can you share an example where stronger assurance, either a review or an audit, materially improved a lending outcome?
There are a lot of examples. I had a situation where a customer, a prospect, sent me some NTRs, and based on NTRs, I got a little bit of information. But I said, "Hey, we're not working based on NTRs. If you can get me higher quality financial statements, I would probably look at things better." Then they had their accountant on board, and it was easier for accountant to kind of change those numbers quickly and get a better quality. So they got me a review engagement within a week or so, and the review engagement and the 1 week timeline kind of gave me a lot of assurance about, okay, so these people are serious, and they were fast, they acted on it. This means I got to do the same thing for them. So at the end of the day, we were all happy.
Wonderful.
Yeah.
So it sounds like that lending prospect really wouldn't have happened without an assurance on that set of financials.
Yeah, that one was easy, a simple example, because they had NTR and we don't work on NTRs anymore. And I clearly said, hey, this is NTR, it's not working. I can do some reviews. I can come up with, some ratios or numbers and calculate some of the ins and outs and so on myself, distribution, dividends, whatnot. But if you gave me a higher quality, make life easier. Everybody would understand things better, and
Yes.
it would be faster. So they did it, and
Nice. Yeah, and that's something business owners don't always see. It's helping their advocates help them succeed by getting the right information, the right type of quality out. Right.
And another thing that helps us big time in terms of time saving and being fast and less friction and whatnot is sometimes some of our sophisticated clients or prospects are running 2-3 businesses.
Yes.
Or they have a situation where there is a holdco and there is an opco, and there is a, for example, professional corporation and whatnot. So in that situation, there are multiple companies, and each of the companies would have their own financial statements, review engagement, or compilation engagement, or sometimes even audited financial statements. But each of them separate would be multiple times for us to do the analysis on each of them. And if they want to go one step further and make life easier for us and for themselves, we would really love to have a combined financial statements for all the three companies, 3 or 4 entities that they are operating. If these financials are all combined by an accountant, this makes life easier. We could do a lot faster. The turnaround would be easier. All the levels of review would understand the numbers better, and it would improve borrower risk rating too. So that would save them time. That would save them some fees and rates and stuff like that as well.
Yeah, and with the combined or even consolidated financial statements, you can see if revenue has been double counted in error, but you can see who's making what. You can do eliminating entries as well.
Absolutely.
So that way you can do your ratio analysis and your cash flow forecast on the entire organization with the different entities rather than just looking at one at a time.
Yeah.
Yes, I can see that making sense as well. One theme that keeps coming up is trust. So from your perspective, how does assurance affect trust in management? So not just the numbers, but even the trust that you have in the management as well.
So it shows that, when we have a higher quality of financial statements, or let's say audited financial statements, which is the highest quality, it doesn't only tell us, the consistency of numbers and story of numbers and how the revenues worked, how cash flow worked, how, this and that worked, right? The untold story, which is not written on the financial statement, is that the management of company, they are people who are taking their business seriously.
Yes.
They are ready to, they're taking financial reporting seriously. That means they are ready to be, under scrutiny. They are ready to talk about things. They are ready to, they leave the work to professionals, right? As I said earlier, they know how to run their business. If it is an engineering firm, for example, they know how to do their engineering work best. They might not know how all the numbers work, so they are involving the professionals to do the work and the right type of work. That means the company has stronger management, which is 50% of normally what we look at. 50% is who are running the companies, and 50% is on the financials and all the ratios and so on. So healthier risk culture is what these people are showing through doing higher quality work.
So it's not just I guess the key distinction is with the assurance type engagements, it's not just technical, it's also reputational as well in terms of
yeah of course. Yeah.
So, what this makes clear is assurance levels don't just sit in the background, it actively shapes capital outcomes. So, Mirza, I want to thank you for joining us today. Really appreciate your insights. Really give a good perspective from the commercial lending perspective. And I think that adds a lot of impact to our clients and to our viewers as well. So, thank you for being here today.
My pleasure. Thank you for inviting me.
Next, I want to step back and summarize what sophisticated business owners should take away when deciding between review and audit engagements, and how to align that decision with the growth and financing strategies. I want to close by stepping back from the technical details and focusing on patterns. After working with business owners, lenders, and advisors over the years, there are clear differences between companies that struggle to access capital and those that don't. It rarely comes down to intelligence or effort. It comes down to how deliberately they approach financial reporting. The first thing high-performing businesses do is they don't wait until they need financing to upgrade their financial reporting. The moment you're under time pressure, whether it's refinancing, growth, or a transaction, you've already lost leverage. Strong financial reporting is most effective when it's in place before the conversation with a lender or investor begins. For many businesses, a review engagement is the right tool at the right stage. It provides credible, independent verification without the scope, cost, or disruption of an audit. High-performing businesses use reviews to elevate credibility, improve transparency, and signal that they take financial reporting seriously. It's not about checking a box. It's about creating confidence proportional to the size and complexity of the business. As the stakes increase, so does the need for trust. When businesses are pursuing larger financing, engaging institutional capital, or preparing for a merger and acquisition, audits become a strategic decision. Not because someone forces them, but because audits provide the level of assurance required when third parties are committing to meaningful capital. High-performing businesses understand that at that level, assurance isn't optional, it's foundational. The most important takeaway is this: the choice between a review and an audit is not just about compliance. It's about strategic positioning. It's about aligning the level of assurance with your growth plans, your capital strategy, and the expectations of the people you want to do business with. For sophisticated businesses, financial statements are strategic assets, not compliance artifacts. Investing in professional review or audit services enhances credibility, reduces friction with lenders, and positions the business for better capital outcomes. If you're thinking about growth, financing, or a longer-term strategy, it's worth reflecting on whether your current level of financial reporting supports those ambitions. More information on review and audit engagements is available on our website for those who want to explore the differences, but real value comes from aligning assurance with your strategy. Ultimately, the goal isn't more reporting, it's better outcomes.